sides to a really great financial future. Tom and Don are talking real money.
What is a model? A model. It could be it could be a small airplane that somebody made in their garage. That could be a model. It could be somebody walking a runway in Paris. That's a model. It could be behavior. Model citizen. That's a model. Or, when it comes to talking real money, it could be a model portfolio. Today's episode, all about models, model portfolios. Do you need them? Should you have one? How do you get them? Who's making them? What are good? What are bad? We're going to cram all of that into about 10 minutes. I'm Don. That's Tom. This is the Talking Real Money Model Podcast.
Yeah, and the thing about the model
we're model
play
citizens.
on words is I use it at home. Now, I'm going to go out to the garage and work on my model. It just gets a big eye roll. Okay. We get
Again?
That's hilarious. Yeah. Again. How many eye rolls can you do in one day? But I got it coming. So the thing about model portfolios is I don't think many people understand that really at the end of the day, if you're working with an advisor who's not using a model portfolio, and by that I don't mean everything's not built for you individually, but there is a set of investments, a set of rules that go with that. They don't get to pick
I need you
anything.
to step back. I need you to step back, though,
Way
because
back.
that's where the confusion comes in. A model portfolio sounds like a cookie-cutter portfolio that applies to everybody, but that's not what a good model portfolio should be. It's more of I'll date myself. It's the little metal parts of the erector set that they're all to the right scales, and you use those parts to create the Ferris wheel or whatever it is you're trying to build.
Exactly. You'll date yourself, by the way, because no one else will. That's why. But
My wife still dates me.
Okay.
Barely,
but the thing about that is, a model portfolio has picked out the investment options. It's a series of exchange traded funds, could be mutual funds. For some people, it's stocks. We don't buy that approach. But it doesn't have nobody here in the building has the option of saying, I'm going to take a DRAM, the hottest ETF ever, and put that in the portfolio. Nobody gets that option here. I wouldn't hire any firm that wasn't using the model approach, okay? That's
because then if you don't use the model, which has been vetted hopefully by academic research and a research department, analysts, and all those guys. The risk is you get put in the latest hot thing that the advisor has read about or has been pitched by a wholesaler or a regional director or something of the company.
Somebody's come up with an idea, a series of ideas. Don't want that. But according to what we just read, model portfolios are now used by more than 80% of they call them fee-based advisors. I would never use a fee-based advisor.
Right. Those are the ones, like, for example, Merrill Lynch has a fee-based advisory. They're fee-based, not fee-only.
Troubling, because there you could be sold a commissionable product. But there's still problems with model portfolios because what goes into them, it turns out, becomes rather important. If that's
you mean the devil's in the details of the model.
Yeah, exactly. So when we read recently that Morningstar is partnering with people like Apollo and Franklin Templeton to build 6 model portfolios that will use traditional exchange-traded funds, and guess what else they're going to throw in there? Alternative portfolios, like you already know the stuff, right? Private investments, private equity, private real estate,
private lending.
All those things are going to be added in. So now you're going to own what you thought was a diversified portfolio, and they're going to have exposure to the public and private markets. I don't like that because it's just it's bearing bad stuff in there that you might not be aware of.
And again, here's a great example. This is a company, Morningstar is a company that has for literally decades been providing us with great information that we use to help educate you. Vanguard is another company that has provided great products for investors like you. But both of these companies appear to be kind of jumping the shark a little bit in search of magical excess profits somewhere. They're they're overstepping their sensible bounds, in our opinion, and getting into things that could be really dangerous, potentially, for their users. And these private products are a great example, Tom, because there has been a lot of news recently about a lot of investors. They're not flooding money. They're not flooding into these things. They're not pouring money into them. They're desperately trying to get their money out of some of these private equity products.
And they can't. There's for a variety of reasons, right?
Well, illiquidity.
Yeah, that would be the biggest one, of course. I struggle with people like Jim Zettler, who is the president of Apollo, when he says the next generation of model portfolios will blend public and private markets and offer investors greater diversification, more yield, and reflect the full breadth of the economy. Now, you know what they're really saying here is, read between the lines. Look, fewer and fewer companies have been going public in the last 20 years. So all of these smart ideas, the hottest stuff is private. So you need to make sure that your portfolio is exposed to those, right? Because there are fewer publicly traded stocks. Well, think that through a little bit. Why are they waiting? Well, they may be waiting because they don't want to go through the rigmarole of going public, which is not an easy thing. But for many of these companies, they're not going through it because they're probably troubled in some fashion, or they haven't been tested in a variety of markets, or a lot of other things. Or it's an idea, can you say pets.com, that probably doesn't deserve your investment.
And the other thing that these private equity products and private lending products and private money products that are run by companies like Apollo, which is a big hedge fund manager, a big private equity manager, these things are expensive. You don't get this on the cheap like you do VT for, six. What is VT these days?
It's
6 basis
less
points?
Less than 10. Let's just
less
say
than
that.
10.
Okay? We'll say that.
With Apollo, they typically charge individual investors. Now, I don't know what they're going to charge through Morningstar. That was not released.
Nope.
Don't know the number. But they typically charge somewhere between 1.5% and 2% a year to their individual investors. And then they have what is called the carry. And that is 20% of the profits the fund makes, sometimes over and above a certain percentage. If they make under that, then they don't share the profits. If they make over that, they share the profits. But this is a very, very expensive proposition, and there's just not great evidence that the old 2 and 20 model and the private equity selections in aggregate outperform just buying the cheap old market.
Yeah, the publicly traded cheap old market. By the way, I struggle even more when people like Franklin Templeton's CEO Jenny Johnson says, we're living in an environment of persistent inflation and structural uncertainty. Now,
what the heck does that mean?
Structural
uncertainty. Are we about to have a mega nationwide earthquake and we're worried about buildings falling down? What is... Yeah.
Check your crossing. Yeah,
okay, did Jenny ever read history?
And persistent inflation. I mean, inflation's at somewhere around 3.5%. That's fairly, if you look back 100 years, pretty average. I mean, inflation average is about 3%. So that's a silly thing. But here's a bigger struggle for me, frankly, that they are saying that in these interval funds, they expect the private portion, which could include equity, credit, real estate, all those things, to be somewhere between 12 and 20% of the portfolio. Now, that sounds even, if you're going to have any exposure, it would be, for me, very, very small. But 20% of your portfolio to be in private things where, again, as you point out, more expensive, less liquidity, and it has to be riskier, right? Just by the nature of it.
Yeah, and I want to come back to Jenny's inflation thing because I think facts are just lovely things. When you talk about an inflationary environment, are you nuts? Were you born in 1995? In 1974, the U.S. inflation rate, the rate was, according to the Federal Reserve, 11.1%. In 1979, the inflation rate was 11.3%. But wait, there's more.
Yeah.
In 1980, it was 13.5%. Now, that was an era of persistent inflation, because from the average inflation rate over the 20-year period from 1970 to 1990, so if you average all of it in, the low and the high, it still was 4.5%, higher than today's rate.
Indeed.
For 20 years. That was persistent inflation.
And the bridge is held. So you had the structural integrity as well. Those are silly reasons. And there's a person named Benjamin Schifrin, who's the director of securities policy at Better Markets, says, and this is where I completely agree, the private funds industry now wants to get its hands on the trillions of dollars in retail investors' retirement savings.
Well, here's what happens generally. They run out of smart money that's gullible enough to go with them. The big money, the ultra rich. Finally, the ultra rich are going, wait, why are we buying into these products when you're not even beating the market in aggregate again? Why are we pouring our money in? They're pulling their money out. We see that happening right now with some of these. The smart money is pulling their money out, or trying to, and they're having a hard time doing it. And then the industry comes after you. You're the last one they come after. You're their last resort, and your advisors, your trusted managers of your money, many of them are going to fall prey to this Morningstar product. And I'm not saying it's illegal. It's not. I'm not saying it's totally ethical, because I don't think it is. But it's, of course, it's capitalism. It's a free market. They can do what they want to do. And we can, in that same free market, warn you that this kind of stuff could. We don't know that it will, but it could really bite you later. We just don't want. Honestly, I know we're capitalists too. We'd like for our firm to make money. Yeah, whatever. But really, truly, honestly, our main focus is really making sure you're taken care of, and that's why we bring this stuff up. So there we have it. Now, something funny happened. It's probably just from us being whiny.
There's a bit of that going on, yeah.
But over the summer, or as summer got started, the questions waned a little. And we let you know that the questions had waned.
The complaining began.
We complained. And this show was recorded just days before Tom goes on an epic vacation throughout the Mediterranean, trying to recapture the glory of what was once the Roman Empire.
That's right. You didn't? I've got my toga all ready to go. So
toga. And so,
away, man. Yeah.
Just so we get caught up, suddenly all these questions poured in. This is airing in July after you get back from vacation, but we had to record him in advance because he would be on vacation. So we got to go through a whole bunch of questions right now that came in at talkingrealmoney.com just by hitting that button that says Ask a Question upper right.
Yeah, and I want to point something out.
What?
I want to point something out here. We take all comers. We don't edit we're going to edit one just for length.
Well, okay, we sometimes edit for brevity.
Yeah, right. But other than that,
or I edit for your mistakes. If I hear you guys, like a couple of my caller ones, that was like they restart, and I go, okay, I'm going to take that.
I wish you'd edit my mistakes.
No.
No, I know you love keeping them.
No, they're way too much fun.
So we take them all. And this one is, an interesting, a fascinating, and sensitive, I'd say, topic. So, and I went and asked a few people in our company about this too. So just to give you that, Joseph from Eatonville, Washington, he writes, hello, Tom and Don. Recently, on your June 10th podcast, a listener asked and questioned the AUM fee, Assets Under Management fee. That's where advisors, this is my words, charge a percentage of the money they manage for you. So, and you may have heard Mr. Ken Fisher say, the more you make, the more we make. Mm-hmm. Yeah, and we go on. You both explained that the flat fee or hourly is not as holistic and basically could never do or cover as much as an AUM fee covers. Mm-hmm. This is not true.
I don't think we said that. I think it was misinterpreted, but go ahead. Yeah.
Let's finish. And this is not true and not an honest and fair statement for your listeners. There are many flat fee and hourly type advisors who would do exactly what some AUM advisors do, as not all AUM advisors are like Appella. I know this to be true. If you remember me, I'm the guy who ended up interviewing 15 firms before deciding on the direction I wanted to go, and Apella was one of them. They scored well, by the way, as did others, some AUM, some flat fee, and one hourly. I will say that hourly was harder to find as being complete in advertisement, but there are a lot of flat fee advisors giving as much as any good AUM advisors for less cost, especially if you have a larger portfolio. My hope is that you both will correct yourselves on the air for your listeners as to what has been telling them is a bias and not true in today's world. Thank you both for what you do, doing what's right, and be honest.
Okay, let's talk about the three kinds of fees that we're discussing here. One is the AUM. That's a percentage of assets under management. That's what Apella does. Starts at 1%, but it goes down the more money you have. So the fee reduces over larger assets. Then there's the hourly, where you pay someone. Generally in the industry today, it's about $400 to $700. I've seen $750 an hour.
500, but
$500 an hour is probably about right.
Yep.
Pay about what you pay a reasonable lawyer, not the most expensive. Then there's the flat fee, where you pay a few $1,000s, and it's usually a few $1,000s a year, depending on the complexity of your situation. They all have benefits. They all have detriments. And I want to start with the benefits and detriments of the flat fee. I'll get those out of the way first, and the hourly. It's great because there is no financial incentive for the advisor to raise more money to try to get their fee up. But it requires that the client write an actual check. It's kind of like writing a check to the IRS every year. You may pay with this. You may pay a little less, maybe, but not always. And you got to write that check. The other thing is when it comes to a smaller account, we've looked at a lot of these flat fee programs and look at the number. Run it as a percentage of the assets that they'll be managing for you. If you're under $1 million, these flat fees can be much higher than the AUM setup. Hourly means you have to pick the time you're going to talk. You decide when you're going to need advice. Generally, you're going to try and go cheap. You're going to only talk to them when you really need help. Now, is there anything wrong with that? Not if you're good at what you do and if you've got control and you've got a plan and you're all set up. Hourly can be great. Then there's AUM-based, and AUM-based is what Ken Fisher talks about. We make more money, you make more money, but that's really, that's only part of the picture.
It is. Okay, so let's just talk about what you may need as a consumer, right? I mean, if you're young and you're growing your assets, and you could pay somebody an hourly, a certain amount, and they build the portfolio, and away you go.
Yep, I think that's actually a very viable way to go for someone in the and that's why we don't that's why I take issue with the correspondence recollection of the comments. I don't think we said you should not use these things. Because I think hourly works really well in the accumulation phase of life.
Yeah, and we have a very inexpensive sort of accumulator program here. We have an advisor who handles it. I forget what the rate is. It's still an AUM charge, but it's less than the 1% because you don't need as much, right? Mm-hmm. That makes sense. To the AUM side, though, and I asked around the company. I asked Jim Scanlon, our CEO. I asked Jason Gentile, our director of wealth. And their take was kind of what he said here, that the AUM approach feels more holistic. But you're right. The other could be as good. It depends on the relationship. It depends on your needs, et cetera. And what Jason said, I think, was spot on. We feel like our clients are aligned with us, that what we're offering is in alignment. It is the planning. It is the tax planning. It is the portfolio design. It is all those things. And we've done this for a long time, and it's worked for us. Again, it doesn't mean that the other approach wouldn't be perhaps cheaper and might not be just as good. That I don't know.
Here's the problem. There are great, and this was mentioned in the note. There are great AUM advisors, great ones out there. Not very many, but there are some great ones. There are great hourly advisors. There are great flat fee advisors, and yet in the majority, are the bad ones in every one of those categories, but more likely in the AUM category because, folks, that's where the Ameriprizes and the Ed Jones and the Merrill Lynches and the Morgan Stanleys, that's where all of them reside in their fee-based businesses. But remember, these guys, some of them charge, according to their Form ADV, up to 3% per year. That's just bad on the face of it.
Yeah, it really is. So, Joseph, I hope we've answered this. We're happy to take this question up again. It's a good one. Again, I think in our practice, this has worked well and is continuing to work well. I think our clients would say so as well. But again, this is
and we're trying to be really, really, really fair about it. Initially, Tom and I, when we started Vestory, we were doing 90 basis points, 0.9 of 1%. Yeah. And here's the problem. It may sound like an awful lot of money when you look at it as a percentage of your money, but when you see what the costs of running a registered investment advisory firm are behind the scenes, you would be shocked. And we really had to go to one to make us a little bit of money. Us, the owners.
Now that we don't have to look at that anymore.
We don't.
I like it. Somebody
else takes care of all those expenses. I'm good with that.
That's good. From Parsons, Kansas, John writes, Dear Don and Tom, thank you for the excellent show. Question. If I have 10 exchange-traded funds and mutual funds at, let's say, Vanguard, with an expense ratio of 0.10 each, does that mean the total expense will be 1% for the entire portfolio? Do you simply just add them up?
No, because it's 0.1% of 1% for each fund. So the total for the entire portfolio is 0.1% of 1%. That's what you're paying. You're paying 0.1% of 1%. I'll do it this way. You've got 10 accounts, each of them with $10,000. Well, let's use $100,000. 0.1% of 1% is $1,000. Is that right? Is that 1%? No, it's $100. Sorry, I'm using 100,000, right?
Well, we can charge 1,000. That's sure.
No, let's go. It's $100. So you got 10 of those, each charging you $100. That's $1 million in funds. The total charge across the whole portfolio is $1,000. 0.1% of 1%.
Yep. Okay.
You don't add them up.
That's it. That's pretty simple. Okay.
We're going for 4 questions today.
Okay,
4 questions.
Got to keep working. Candia, New Hampshire. Chris writes, probably Tom and maybe Don. I don't know what that means, but it's funny. Okay, I'm a big fan of the show. I've been listening for several years. My wife, 43, and I, 38, are right on the edge of the Roth IRA income limit. And since that's there, what is the Roth? What is that this year for?
I don't know.
I'm going to say $195,000
for a couple,
something like that. If you make more than that, you cannot put money directly into a Roth IRA, and you'd have to use the backdoor.
It is for a full contribution, ladies and gentlemen.
Yep.
A modified adjusted gross income. Got to make sure that that's in there.
That's right.
Of $250,000.
$250,000
is the cutoff. Yes.
More than I thought. Okay.
At $260,000, you're totally out.
You're out. Okay. Fair enough. Okay. So he continues, Chris does. I would like to have a plan to deal with our IRA balances before this becomes a problem. Our 401ks use Fidelity index funds for S&P, International Large Growth, U.S. Small Blend. So we use our IRAs and Roth IRAs to capture the rest of the asset classes in Paul Merriman's 10-fund portfolio. If we rolled the IRAs into our 401ks, we'd significantly reduce our tilt to small and to value. Instead of contributing $7,500 to each Roth, wouldn't a conversion from an IRA to a Roth that has a tax bill of $7,500 accomplish the same thing in retirement? I haven't heard this option recommended.
Wait a minute, I don't understand. Yeah, I'm not understanding the question.
I think what he's talking about.
I don't know why he'd want to put it into his 401k and lose the small value tilt. And
but if he does that, if he cleans it up, you're only 38. If he cleans that up now, and he's under the income limit, then he could start making regular Roth contributions and then buy the small value and all the stuff that you don't have.
Wait. 401k. Oh, okay, hold on.
So he's got.
How is moving the
IRA?
How is moving the IRA into the 401k going to reduce his income?
No, I'm not. That two separate things. Not conflating them. No.
Okay.
No. In fact, it's going to increase his income because you move money from an IRA to a Roth. That's the same as taking income.
Right.
Yeah. No, what he's asking about is it doesn't make sense to sort of clean. In my mind, he's asking, should I just clean things up, get rid of the IRA? Now I just have the
regular
Roth.
IRA.
Yeah.
No. No, you'd lose his small value tilt.
But then he won't be able to do the backdoor is my take.
Oh, because of the pro rata rule.
Correct. That's what
How
I'm
much
saying.
is in his IRA?
He doesn't get into that.
I mean, it really would depend. I mean, because it's a pro rata rule. It means you don't have to take it. You don't have to pay taxes on the whole thing.
Or you could do it over time, too. But then he goes on. He said, I've just discovered my 401k as a BrokerageLink option. From what I can find in the documents, there's a 100% annual fee, and it can manage up to one half of my 401k, currently $550,000 total. I don't like the unnecessary fees, but this seems worth it for the extra exposure to small value emerging markets. Is there anything to be wary of?
Was it $100? Because you said 100%.
$100, pardon me, 100%.
$100 a year on a $550,000 portfolio seems pretty darn cheap, particularly if the funds he's using are higher expense funds and he can get really low cost ETFs through the direct brokerage option.
Here's the thing.
You know what I'm saying?
Yes, I think BrokerageLink makes sense. Again, I'd have to look at all of the funds available in your current 401k before I said absolutely. But I still, at your relative young ages of 43 and 38, want you to commit a sizable amount of the savings into Roth, whether that comes in your Roth IRA or in your current 401k, because you want to have those different buckets when you get to retirement 20 years down the road. It's going to be important.
What about, though, just thought, what about, since they're putting a lot of money away and they're right at the limit, they really can't make the Roth anymore, or the contribution, why not move all your 401k contributions to the Roth option?
Which you could do, right.
Which you could do. So you could still get a Roth.
Yep.
And still do the regular IRA and get what you're doing is you're swapping deductions possible. Well, no, you wouldn't get a deduction for the IRA anymore.
No.
Not anymore. But I don't know. I think I might go with the Roth and the 401 though, if that's an option for you.
That is. Then you build the Roth there. You use the BrokerageLink to get the proper exposure to the other asset classes that you correctly point out you don't have.
And then you can gradually, if you want to, start converting that IRA slowly so that you do some tax management along the way. You don't creep up a bracket.
Yeah, I agree. So we got one more here. Got time to do it?
We have. Sure.
Okay.
What the heck?
Farmington, Connecticut. Shane writes, hi, Don and Tom. My wife and I aren't satisfied with the investment options in her 401k. I understand the traditional advice in this situation is to at least invest the minimum to get the match and then put the rest in your brokerage account. However, my wife is very well compensated, and contributing the minimum to get the match actually maxes out the 401k. The match ends up being $20,000, which is great.
I don't care what the options are. Honestly,
you want the $20K.
I want the free $20,000.
A lot of money.
That's a lot of money. The options can't be that bad. Okay, let's assume. What do we have any of the options?
Well, her 401k is through T. Rowe Price.
Okay.
Not the fees that give us pause, he says, but the prevalence of active funds without broad diversification and with turnover rates of greater than 50%, including one with a whopping 230% turnover. The index offerings are all Spartan index pools, which I understand are collective investment trusts. I found it hard to find information about their holdings. So,
do those. These collective trusts are, they're not as
very transparent.
They're not transparent, but they said they're indexes. Okay,
Yep.
Therefore, portfolio transparency is not an issue.
Yeah.
What's the issue is the fee transparency, and generally speaking, these collective trusts have lower fees than comparable mutual funds because they have less regulation. I love those. I mean, I'm already good with that one.
The question is, the 401k prospectus offers a self-directed brokerage through a Schwab personal choice retirement account. Sound familiar?
Oh, that was the previous caller.
Because this sounds like exactly what I'm looking for. Prospectus says T. Rowe Price will charge us $50 a year for this, but this is going to be the only fee if I stick to ETFs. I can't find a list of the investments available in the Schwab personal choice account. I think it's anything. It's Schwab.
Everything is available in that. So AVGE,
Right.
DFAW, VT, all of those ETFs. Now, not all the mutual funds, but the ETFs are all available because they trade as regular stocks. That is the best option of them all. It's $40. We just said do it for $100.
$50. If I said
50.
40, I
50.
misspoke.
I'm sorry. 50. I know. I just misheard.
He does say that the plan may limit the investment alternatives you may purchase in the brokerage account, but provides no further details. I think it's right. I think it's just some of the limitations in the mutual funds. Is this oddly exactly what we're looking for?
Oddly, it's exactly what you're looking for.
Yeah.
Or the collective trust. You know, if $50 bothers you, which it shouldn't because your wife is highly compensated, and now suddenly what you do is you take a mediocre plan, you get the free $20,000, and you make it a great plan for $40.
50.
Why do I keep saying 40?
I don't know. I corrected it.
I have got 40 in my head for some
Don's
reason.
apparently going to throw 10 at it just so you do it. So.
Yeah, I'm. Oh, that's it. That's my subsidy. Yeah. If 50 bothers you, let's take it down to 40, shall we?
Exactly. You're selling like
I don't know why I thought it was 40.
Yeah, no, that's a good option.
Now watch, I'm going to leave my mistake in too, though.
Okay. I'm going to check to make sure you
I
did.
am.
So, no, I think that's a very good option. And by the way, congratulations on the $20K. I just read again. I hate to pick on them, but Costco's match, $500. Doesn't matter what you make. Doesn't matter what you're putting in. $500 in your 401K.
Well, you know, I was just at Costco, and the prices are so good that I can see why they can't afford to do that. I got a bottle of avocado oil, and it's funny, I went to Costco yesterday, and then I went to Publix.
Yeah.
To get a few grocery things. And I saw the same bottle on the shelf, except it was a little shorter. It's a smaller bottle, because, of course, it's smaller. I paid, I think it was $18 for the avocado oil at Costco. At Publix, it was $23 for a smaller bottle.
All right. Yeah.
See? Okay. So, you know, Costco can't afford much more than that, apparently.
I'm going to let you say that. So.
And I got gas. I didn't have the hot dog. That, you know, I know there's gas from that.
$1.50 for the dog.
I went to the gas station at Costco. My gosh, it felt good to fill up at $3.46 a gallon.
Wow.
$3.46 a gallon.
You could pay at least $2 more than that here. I still see $6 from around town.
That just
Don't they know the war is over? It's peace,
darn
and
good.
the Hormuz is open.
And it's so funny. We went in to get some olive oil because their olive oil is so good. And Debbie had a hearing aid thing she needed to deal with, and we ended up walking out with $250 worth of stuff.
Surprising, right?
I swear, stuff just jumped in my cart on the way out of the store. It's like, how did that get there?
There's two reasons I don't go there. Number one, things like that. Number two, I get hives with that many people around, so I just don't.
No, I found the key. We went on a Wednesday at 2 p.m.
You take the break after lunch, blah, 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 everybody's home.
Wednesday at 2 p.m. I found the day because we go in there on a Saturday or a Sunday.
Forget it. No way.
And I start feeling a little anxious and suicidal.
I couldn't.
I want to jump from the top of one of those really tall shelves.
I'd still suggest that if I were you. So
okay. Good idea. Thank you all. We appreciate you being there, and keep sending those questions in because we'll get them answered. We will eventually. We're working on them. You can also speak them, and they go to the Friday podcast. And by the way, the Friday podcasts are, you know, the questions coming in for those have been great. So keep that up and keep listening and keep telling your friends because the more the merrier. Because everybody out here in the United States of America and beyond. Oh, yeah, Toy Story came out a couple of weeks ago.
Yes, it did.
To America and beyond needs to be what? Talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Wealth, a fee-only registered investment advisor.
Please see Apella Wealth's ADV Part 2A on our website for information regarding Apella's fees and services.
Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.